I'd like to thank everybody that is joining the Panxora team for this discussion on the practicalities of managing cryptocurrency volatility and the choices that are available in the market today and how viable they are. So welcome to all of you who have chosen to attend. My name is Marcy Turman. I am the Chief Operating Officer of the Panxora Group. And we have decided to run these seminars because even though cryptocurrency, I think everybody who is here would agree, we're in a bull market right now. Well, we happen to have reached a period of consolidation, which makes it very clear to people that even though there can be a very strong bull market, markets do not move in a straight line. And I thought it would be quite interesting just to illustrate right now that this is the Bitcoin market over the past month. I don't know how you perceive the market to be moving. It feels quite strong to me, but it actually has entered a range. And whereas it's quite pleasant when the market is going up, it is not quite so pleasant. It starts to feel uncomfortable when the market moves sideways. And then when the market actually enters a downtrend, it gets really uncomfortable. And everybody agrees that having some methodology to manage the volatility of your cryptocurrency position makes a lot of sense. So Gavin Smith, Panxora's CEO and the member of the team that really lives and breathes and understands risk management in depth, has put together this presentation. So at this point, I would like to pass the baton over to you, Gavin, and if you could tell us about the options that are available to people who want to manage their cryptocurrency risk. And by options, I mean choices.
Absolutely. Thanks very much, Marcy. So as Marcy said, it's going to be a very short presentation on a report that we carried out looking at two options of how to manage risk. One using the option market, one active hedging. So before I go over the findings of our study, I wanted to briefly touch on who would use hedging and why. So a large number of Bitcoin early adopters, they take the view that they don't need risk management. In popular parlance, they're hodlers. They hold on to their Bitcoin and that's their approach to investment. Any selling or hedging of their Bitcoin is almost considered a breach of faith. It's a different story for corporate investors or family offices. Their risk committees will want to see a viable risk management approach. So what we've done with this study is cover two of the most popular strategies that are available. Using options to hedge your risk and also using active hedging as a risk management tool. So many of you will be familiar with the first of these, options hedging. If not from the crypto space, then certainly more traditional markets. Options have a number of benefits, most important of which is a clearly defined risk limit. This safety that's provided can, however, come at a cost and be quite expensive depending on the market volatility. Now, just to be clear, for the purpose of this report, we're assuming that simple hedging is done with the purchase of put options to protect your Bitcoin position. We're not considering selling upside calls as hedges. While a perfectly viable strategy, we consider this approach a yield enhancement technique, not a risk management technique. We're also not considering purchasing calls to increase your exposure as an options hedging strategy. Again, that's more a trading approach, a trading style. The second approach, I think people will be less familiar with. In its simplest form, an active hedge seeks to protect the portfolio by simulating an options position. This is done by calculating the delta of a theoretical put option, the implied protection that you're putting in place. As the market goes down, futures or forwards are sold to increase the hedge. As the market rises, some of these hedges are closed to reflect the delta of the virtual option. As you can see, buying and selling is done in the wrong direction. You're selling low, you're buying high. And that actually makes, that generates the cost of putting that hedge in place, but it does provide protection against large moves. So with active hedging, it has the benefit that you can use the technique even in markets with little or no option capability. It's also often cheaper than the actual option purchases because you're trading that delta at market volatility rather than an implied volatility that often has a premium in there. The disadvantage of the approach, because you're replicating an option through delta hedging, the strategy cannot guarantee an exit in the way an option can. Now, moving on from that, as modeling became more advanced, simple active hedging was replaced by dynamic hedging. Dynamic hedging still draws on option modeling techniques to generate an implied delta of a portfolio, but this is combined with volatility modeling. Depending upon the expected forward volatility, the hedge will be increased, decreased, or sometimes removed entirely, an approach that's been found to significantly improve the effectiveness of the active hedging strategy. So I want to move now on to really the meat of the report, the actual figures that we found and the results of the research. So for the purpose of this study, we used the Bitcoin market from 2018 through to early 2021. We selected this period for two reasons, really. Firstly, it covers a bear market, a period of consolidation, and a bull market. Coincidentally, it also ties into when Bitcoin options started to make an appearance, started late 2018 in real terms, early 2019, and the market's grown since then. Our approach was to analyze the effectiveness of serial 30-day option protection. We used two strategies. One strategy used at-the-money puts for protection. The other used puts 10% out of the money. For the purpose of valuations, we used a central case of 80% implied volatility on the options. To test the effectiveness around that, we also used 95% and 60% as outlier levels, just to see how volatility changes, implied volatility changes, impact the effectiveness of the approach. Now, to put this in context, we're currently trading in the mid-90% for at-the-money options, that's on 30-day options. In recent history, we've traded up to 150% and as low as the mid-50% in 2019. So the second derivative, the volatility of the volatility, is quite dynamic in the Bitcoin market, as you'd expect from an early stage asset class. Now, for the dynamic hedging model, we used a medium-term outlook to assess volatility risk. We compared the strategies against, we compared the option strategies against dynamic hedging and also versus buy and hold to give us an overview of the various approaches that could be taken. Now, as part of this presentation, I'm going to give an overview of the key statistics. But after there's a lot of information to pull together. So after the presentation, what we'll do is send a full report with full coverage of the numbers to participants. Now, what surprised us when we ran the numbers was the relative subpar performance of the option strategies. The central estimate of implied volatility saw the portfolio return volatility reduced, but it was reduced at quite a significant impact to average monthly returns. If we look at the at-the-money strategy, portfolio volatility fell from 79.2% with buy and hold to 55.7%. So quite a good reduction in the volatility of the portfolio. But average monthly returns also dropped from 4.8% with holding Bitcoin to 2.6% with the ATM strategy. The out-of-the-money strategy fared little better. Portfolio volatility dropped less, it dropped to 67.3%, but the average monthly returns were still only 3%, so still quite a bit lower than what we got with buy and hold. In both cases, the Sharpe ratio actually declined from simple buy and hold, from 0.96 to 0.66 and 0.63 respectively. So while it reduced risk, the offsetting reduction in returns was quite disappointing from a pure option strategy. Dynamic hedging fared significantly better. The volatility of the portfolio reduced to 49% with dynamic hedging, while maintaining monthly returns at 4.9%, which is slightly higher than buy and hold. The Sharpe ratio also came in significantly better. It came in at 50% higher than buy and hold, at about 1.5. Looking at the outliers, so as I said earlier, we also looked at extreme volatility levels. The out-of-the-money strategy fared much better when running at a 60% average implied volatility. Not surprising, obviously, because the options are cheaper. While still falling short of dynamic hedging, the results were a definite improvement in buy and hold. And it perhaps indicates that at the moment, there's a possible strategy of using options that can be purchased at low levels to provide protection on the portfolio. Now, this becomes much more a trading strategy rather than a pure hedging strategy, and it needs to be managed correctly, but it's worth factoring it in, especially if you have an in-house options team. What we also wanted to do was split the returns by year. So look at how the strategies performed in a bull market, bear market, and sideways. Doing that analysis actually provided quite a bit of additional insight into the relative strengths of the different approaches. As you would expect, during the bear market, all hedging strategies outperformed buy and hold. The best outperformance, again, was dynamic hedging, achieving an average 5.7% per month outperformance over buy and hold. The out-of-the-money strategy, also good outperformance of 3.7% a month over buy and hold. And the out-of-the-money strategy lagged with an outperformance of just 2.1% per month. The difference that jumped out, was actually the 2019 performance. During this year, which was really characterized by some long consolidation periods, both option strategies underperformed. They underperformed dynamic hedging, but also underperformed buy and hold. The underperformance amounted to between 3.5% to 4.5% versus buy and hold. And what became clear is that underperformance was really down to the premium levels of the options. The premium levels just don't sustain a serial hedging of options. There needs to be a lot more thought given to option hedging at this stage in market development. So at the end of the study, the conclusions for us were pretty conclusive. At this stage in market development, a dynamic hedging strategy has real benefits over an option strategy, has benefits in both risk reduction and also in the returns generated. Looking at 2019, as I said, gives some good insights into why that's the case. The volatility of the investment is simply not sufficient to justify the option premiums we're currently seeing. Looking at implied volatility versus the forward actualized volatility, there's about a 10% premium over actualized volatility. So in effect, you're paying 10% in vol terms over the hedging value of those options. Add to that a bid-ask spread, which varies from 2 to 3% with the more active exchanges to anything 8% and above at some of the others. And you can see the cost of option hedging at the moment really starts to mount. Now, I want to be clear, we're not negative on the longer term outlook for Bitcoin options. What we're seeing in the Bitcoin option market is not uncommon in new emerging assets. Experience from other markets shows that over time, we would expect spreads to narrow and premiums to decrease. There are also, looking at the market and looking at it in some detail, there are some interesting hedging strategies that can work even in today's options market with a little planning and a little analysis. A good example is currently you've got a lot of downside skew, a lot of increased volatility. So there's opportunities for putting on some long-term put spreads. Doesn't give full protection, but it gives you good cheap protection for a limited fall in the marketplace, so 10, 20, 30%, which during a bull market is often what we're gonna see in the Bitcoin marketplace. So definitely worth giving some thought, definitely worth putting some analysis in if you've got the team that can pull that information together. For ongoing risk control of a larger portfolio, at the moment, dynamic hedging seems to have the edge. It gives better risk rewards, also allows you to move larger amounts of hedge without moving the market as heavily as you would in the options market at the moment. Now, as Marcy said, we're trying to keep these presentations brief. We'll send over full report information and elements that may be of interest after the presentation. But I wanted to just leave it open 5 minutes to see if there are any questions or anything that wasn't clear to anybody during the presentation.
Hi, Gavin, we have a few questions from the attendees. Would you ever advise incorporating a cowriting strategy into your overall hedging program? And at what point in the cycle?
Okay, so let's cover that in two elements. Cowriting is a valid strategy, especially when you see option premium at a premium, as you currently see. So for us, it's a yield enhancement strategy. Now, where we have seen it used in a hedging context is where you use the selling of the calls to finance downside put protection. So that way you forgo some of the upside gain and use the premium or some of the premium to buy some downside protection. So that's what I would term more a risk management strategy. So yes, it's a valid strategy. Yes, I can see the value to it, but in its own right, selling upside calls, we wouldn't consider to be hedging against the risk per se. It's enhancing the yield and therefore softening the blow from a decline in the market. The other thing to bear in mind, I mean, the strategy really comes from the equity space where volatility is a lot lower. The thing you have to bear in mind with Bitcoin, and you can see it in the figures we'll send through after this presentation. With Bitcoin, you get short periods of, or historically have had short periods of very dynamic upward moves. The danger with selling up a covered call strategy is that you get taken out of your physical position. So the very periods, the very quarters that give you excess upside returns to your portfolio are exactly the times that you get taken out of your Bitcoin position. So just bear that in mind as well. You could miss out on some of the dynamic upside that you get in this marketplace.
We've asked for someone has asked for a bit of clarification about something you stated in your presentation. Did the simulation use put spreads or just at the money versus out of the money puts?
So for the report information that we provided, we used puts. We didn't use put spreads. With some follow-on analysis, we've looked at different strategies that may improve the returns. One of those is using put spreads. And I'm actually, me and another member of the team are pulling together some figures at the moment that look at the effectiveness of put spreads over time. Now, this is will have to, by necessity, be a shorter time period because there isn't option volatility going back to 2018 is quite limited, even 2019. So it's more likely to cover the 2020 period. But we're looking at whether there's a consistent approach to using put spreads that can enhance returns. And to just give you an idea about where we come from in this, what we always look for is automated strategies. So there are absolutely ways that a good option analyst can take advantage of the options market at the moment because it is quite an inefficient market. So opportunities do come up. What we try and do is see, okay, how can we systemize that so that we can provide consistent, regular results, not just sporadic results on hedging that asset. So that was a long answer to your question, which basically says yes, we did outright puts for this study. We are doing a study for put spreads, and anyone who's interested will happily send that information on when it's complete.
What are the main exchanges where these options are currently traded?
There's a number out there, and the number is growing almost daily. But the real volume at the moment is around Terabit. That's where that provides most of the time the best spreads and good liquidity. But some of the other major exchanges like OK Group are bringing out options exchanges. You've got CME. So there's a lot of contenders, but at the moment the best pricing seems to come from Terabit.
What is your opinion, if any, on move option contracts on FTX? This is a website, ftx.com. And what function as bi-directional put and call contracts?
So in effect, you're trading a straddle. You're buying a put call, buying a put, buying a call. So you're buying the straddle. I haven't analysed the market. Under most volatile markets, historically I've done a lot of work in commodity markets on this question, and if you're going to trade a pure volatility trade like that, then what you're looking to do is buy in a low implied volatility and then delta hedge, and that can work very effectively. Again, because of some of you will know this, some of you won't. You're not tied to doing a straddle. If there's good value in puts, for instance, then you can buy the puts and you can buy a 50% delta in the futures to give you effectively a straddle position. So there's ways of synthetically structuring exactly the contract that you're talking about. But if you take that approach, that's normally a trading approach. So it normally works best if it's bought cheap and then delta hedged rather than buying and holding to maturity.
Okay. Well, that comes to the end of the time we have together. I want to thank everybody who has attended, and especially those people who had really good questions about this. Gavin, out of curiosity, do these strategies only really apply right now to the Bitcoin market? We've spoken to companies that hold a wide variety of assets as... Absolutely.
You're starting to get an options market in the Ether product, which has got some depth to it, though clearly not as much as Bitcoin. The other markets tend to be, if they're available, very sporadic. I would say for the other cryptos at this stage, you probably are limited to active hedging. I think any options market for anything other than a small position is going to be quite difficult to trade and quite difficult to protect positions with. So that will change. You know, you see this in all market sectors. As the markets mature, you get more depth. As the market makers are able to hedge their position, they'll have tighter spreads. So it's a growing area, and over the next 2 to 3 years, I think you'll see good option capability across a broad range of the cryptocurrency space.
But for other markets, there's sufficient depth of market and sufficient liquidity to use dynamic hedging for, say, the top 20 cryptocurrencies?
The major cryptos, yeah.
Right.
The thing you need for dynamic hedging is, in technical terms, a continuous liquid market. Where you shouldn't use it, where it falls down, is where the market exhibits discontinuity. So that can be because it's not ideal for stocks, for instance, because you get announcements. But with Bitcoin, it's almost the poster child for a free-flowing 24/7 liquid market. So it's almost the perfect example market to use dynamic hedging.
You've discussed in the presentation, it has solely been about the holding and optimizing your position in Bitcoin, but we work with a number of different large holders of cryptocurrency who are interested in large positions in Monero, also Ethereum. Is there a viable options market in anything else right now? Is it being developed in any other cryptocurrencies, or is dynamic hedging the only realistic approach at present?
You're starting to see a market with depth forming in Ethereum. That's the second largest options market. The other cryptocurrencies at the moment, very early stage of development, so less opportunities out there. At the moment, for the other larger cryptos, active hedging and dynamic hedging would be the preferred approach. But Bitcoin, there's definitely some depth in the market, and Ethereum, there's some depth starting to form.
Would you be able to say something about how you deal with the problem of gaps in the market, extreme moves in your hedges?
Absolutely. That's a really interesting point, because with dynamic hedging, there have been instances where you get a cascade effect in some markets. The two things you need for dynamic hedging to work effectively, which this question alludes to, is liquidity and also a continuous market. Now, Bitcoin has become, and this is a period of evolution, but almost the poster child for a perfect market, because it's open 24/7, and although the moves are volatile and dynamic, there's across the various exchanges there tends to be trading at all the levels. So it doesn't just gap; it trades through to those new levels, albeit very quickly. So what I would say is, for a larger portfolio, it's important to have a hedging engine which will spread the hedges across multiple exchanges. That way, it gives you the best opportunity to actually trade as the mathematical framework expects, on a continuous basis at different levels.
The next question I think is quite interesting, and you may have to delve into opinion here, but would you be able to hedge other cryptocurrencies, so not Bitcoin, but using Bitcoin futures as the method to do the hedging?
Interesting. Historically, and it's kind of bizarre to talk about historically in terms of cryptocurrency, but you saw very high correlation between the various cryptocurrencies. That has weakened as time's gone on, and that really was noticeable earlier this year, late 2020, where Bitcoin took the lead and the other cryptocurrencies lagged and played catch up a bit later. So what you're seeing now is a lower level of correlation. So rather than a true hedge, it becomes a risk hedge. So you can use it as a proxy, and you can use it as a partial hedge, but there will be additional risk there. What I would be inclined to do if I was doing something along those lines is look at a basket of the more liquid cryptos and use that as a hedge, because that's more likely to reflect a closer characteristic to another cryptocurrency. I would also be very careful about using it as a hedge for something that had very different dynamics. For instance, I wouldn't use leading non-DeFi tokens to hedge a DeFi token, because they have different market dynamics driving them. So you need to be careful. You need to structure it with a set of hedges that broadly match the market dynamics of the token that you're trying to hedge.
So it requires quite a bit of understanding of the movement of the various markets, and one presumes, given what we've seen happen this year, it becomes perhaps less viable as time goes on.
Not less viable, but you need to do things in a similar way to stocks is a good example. You know, you can trade a basket of I think there was a study done that if you trade a basket of about 20 stocks, you pretty closely match the index of the overall performance of similar stocks. So you can't use 20 manufacturing companies to hedge a technology index, and vice versa. But what you can do is pick a subset of stocks that match the asset that you're looking to hedge, and they will very closely correlate. So, and you do the usual thing, run correlation statistics against your basket versus the asset. My assumption here is that you'd be looking at hedging a less liquid asset using the more liquid cryptos. So in that instance, I would you'd run correlation stats to see to ensure that the basket quite closely matched your risk asset.
Okay, will you take one more question?
Sure, no, absolutely.
Okay. Would you consider the options market to be liquid enough to do gamma or vega hedges? And do you have any experience of this? And I hope I pronounced the second word correctly.
Yeah, absolutely. So there's with delta trading, actually, never mind gamma trading. What you've got in the option marketplace, and which is quite a large area of opportunity if you're a trader, is actually the second derivative of volatility. So the volatility of the VIX effectively is very high. So there's a lot of opportunity to trade the volatility itself. Trading gamma, absolutely. You know, it's a volatile asset, but you need to be in a position to purchase you need to be market making. That's probably which is beyond the scope of what we're looking at here, but there's a lot of opportunities for people to trade the volatility and make good money market making. The danger you have, and the person who asked this question clearly is knowledgeable of the markets. The danger you have is hedging your tail exposure. At the moment, the reason we talked earlier about there's about 10% premium in terms of volatility over the actualized volatility. A lot of that, it's not unreasonable, because if you're market making, if you're making a market in the options, it's very difficult to cover your tail risk. So any strategy that you do becomes subject to large risk from large dynamic moves, which we see very, very frequently in the cryptocurrency space. So it's I would say it's not something for the faint-hearted.
I think our entire marketplace is not for the faint-hearted.
Absolutely.
Cool. So thank you very much for attending. For those of you who are at the end of your day, enjoy your evening. And for those of you who are starting your day here in Europe, thank you very much for attending. I hope the rest of your day is very productive.